Most people have heard the words mutual funds at least once in their life. Maybe your parents mentioned it, maybe you saw it on a bank advertisement, maybe someone at work said they invest in one. But here's the honest truth. Most people who have heard of mutual funds have absolutely no idea how they actually work, what they cost, whether they're good for you, or whether there's something better out there. Today, we're going to cover all of it, completely, simply, honestly. By the end of this video, you will understand exactly what a mutual fund is, how it works, what it costs, and whether you should put your money in one. Welcome to Capital Secrets, where we reveal what the financial world never taught you. Quick disclaimer, this is not financial advice. Let's start from the very beginning. What is a mutual fund? Here's the simplest way to think about it. Imagine 10 friends want to invest in the stock market, but none of them has enough money to build a properly diversified portfolio alone, and none of them has the time or expertise to research hundreds of companies individually. So they do something smart. They pool their money together. They hire one expert, a professional fund manager, to make all investment decisions on their behalf. That manager decides what to buy, what to sell, and when to move. Everyone contributes, everyone shares the returns, everyone trusts the expert to do the heavy lifting. That is exactly how a mutual fund works. Thousands of investors pool their money into one giant fund. A professional manager invests that money across a wide range of assets, stocks, bonds, or both, and every investor receives returns proportional to how much they put in. Simple, collective, managed. Now let's talk about the main types of mutual funds. There are 3 types every beginner must know. Type 1, equity funds. These invest primarily in stocks. They aim for high, long-term growth, but they carry higher risk because stock prices can be volatile. If you're young with a long investment timeline, equity funds are designed for you. Type 2, bond funds. These invest in bonds, loans made to governments or companies that pay regular interest. Lower risk than equity funds, lower potential return too, but they provide steady, predictable income. If you want stability, bond funds make sense. Type 3, balanced funds. These invest in a mix of both stocks and bonds. They give you growth from stocks while using bonds to reduce overall risk. If you want growth but can't handle big portfolio swings, balanced funds offer that middle ground. Now let's talk about how mutual funds actually make money for you. There are 2 ways your investment grows inside a mutual fund. First, capital appreciation. The value of assets inside the fund increases over time. If the stocks the fund holds go up, your investment goes up too. Second, dividends and interest. Many stocks pay dividends, many bonds pay interest. The mutual fund collects all these payments and either distributes them to you or reinvests them back into the fund on your behalf. Both work together to grow your investment. The longer you stay invested, the more powerful that growth becomes. Now here is the most important part of this entire video. The fees. Mutual funds are not free, and fees, if you're not careful, can silently destroy a huge portion of your wealth over time. The main fee you need to understand is called the expense ratio. This is the annual percentage charged by the fund to cover operating costs, including paying the fund manager and their team. Actively managed mutual funds typically charge between 0.5% and 1.5% per year. Now you might think, that sounds tiny, what's the big deal? Let me show you with real numbers. Imagine you invest $10,000. It grows at 8% per year on average. After 30 years, with no fees, you'd have approximately $100,000. Now add a 1% annual fee. After 30 years, you'd have around $76,000 instead. That fee just cost you $24,000 on a $10,000 investment. Over time, fees don't just reduce your returns, they compound against you, just like returns compound for you. This is why fees matter more than almost anything else in long-term investing. So are actively managed mutual funds worth the higher fees? The honest answer, backed by decades of research, is usually no. Study after study shows that most actively managed mutual funds fail to consistently beat the market over the long term, even with professional managers, even with sophisticated research teams. The majority of actively managed funds actually underperform a simple low-cost index fund over 10, 15, and 20-year periods. Why? Because markets are extremely competitive. Millions of smart, experienced investors are all hunting for the same opportunities. Consistently outsmarting everyone else over a long period is nearly impossible. And when you add higher fees on top of average performance, the numbers become very hard to justify for most beginners. So, how do you actually invest in a mutual fund? Step 1. Decide what type fits your goal. Want long-term growth? Look at equity funds. Want lower risk? Look at bond funds. Want balance? Look at balanced funds. Step 2. Always check the expense ratio before choosing any fund. For actively managed funds, anything above 1% should make you think carefully. For index funds, look for expense ratios below 0.20%. Step 3. Choose a reliable platform. Major platforms like Fidelity, Vanguard, and Schwab offer a wide range of mutual funds with low fees and easy access for beginners. Step 4. Stay consistent. Invest a fixed amount every single month. Reinvest your dividends, and never panic when markets drop. Mutual funds are long-term instruments. Their power comes from patience, not timing. So let's bring everything together. A mutual fund pools money from many investors and uses it to invest across a range of assets, managed either actively by a professional or passively by tracking an index. They offer instant diversification, professional management, and easy accessibility for beginners. But fees matter enormously, and most actively managed funds don't justify their higher costs over the long term. For most beginners, a low-cost index mutual fund is the smartest starting point. Low fees, broad diversification, historically strong returns, almost zero effort required. Because in investing, what you keep after fees matters just as much as what you earn. If this video finally made mutual funds click for you, hit the like button right now. Subscribe to Capital Secrets so you never miss a video. Every week, we break down financial knowledge most people spend years trying to find. See you in the next one. Let's go.